Are you a realtor who is looking to help your clients navigate the confusing world of government loans? You are not alone. With so many different options available, it can be overwhelming. However, I can help you through it. In this guide, we're going to show you some of the most popular government-backed programs and help you with tips and how you can help your clients. My name is Dianne Ayala Steffey. I am a mortgage loan expert. I work with clients to first educate them on the various financing options available to them. First up, let's talk about FHA loans. These loans are backed by the Federal Housing Administration. It was a loan that was created back in 1934. It was designed for clients who are consumers who didn't have perfect credit and had very little to put down. With an FHA loan, you can put as little as 3.5% down. However, maximum loans amount are based on the county. So be sure to look at your county to determine what the maximum loan amount is going to be so that you know what your purchase price needs to be. So how you would do that is you take that loan amount, for example, $472,030 and divide it by 96.5% to get the maximum purchase price of that particular county. But the great thing is that you only have to put down 3.5% on that particular loan. Another thing about FHA, just recently, the mortgage insurance premium used to be based on a factor of 0.85% of the loan amount, which was a pretty hefty monthly charge. Now it's dropped down to 0.55%, which is in competition with conventional financing. Now, as far as credit scores can go down as low as, depending upon the lender that you work with, but FHA technically, you can go down as low as 500 credit score if you put down 10%. However, lenders have their own overlays, and with my particular company, a guaranteed rate, we go as low as 580 credit score with 3.5% down, but the debt to income ratio cannot go above 45%. Debt to income ratio is a percentage of your gross monthly income that goes to pay for your mortgage plus any outstanding debt. Could be revolving or installment debt. So that's a great factor. So most anyone can buy a home if they have good debt to income ratio, they have good job stability, good rental history. And so if you're in that situation, you can very well get into an FHA loan and be a homeowner. Now, with FHA financing, one of the other types of ratios that you need to understand is what we call the income ratio or the top ratio, and that means that your gross monthly income that goes to pay off your mortgage cannot be greater than 47%. If it's greater than 47%, more than likely you're not going to have that loan approved. So there are some things that you can add depending upon the purchase price and the area. There are some certain things that you can do to make sure that your debt to income ratio for that income ratio is lower than the 47%. Another great way of using FHA financing is if you want to buy a primary property as well as an investment property. And what I mean by that, if you buy multifamily, for example, a duplex, a triplex, a quadruplex, as long as you're going to be living in one of the properties, in one of the units, you can buy a property with 3.5% down, still have the investment on the other side, on the other unit, and be able to lease out that property. And the amount of the maximum loan actually is increased based on the number of units that you purchase. So it's a great way to use FHA financing if you're wanting to do both the primary resident as well as the investment property. So that's another key factor to consider. Another popular option is the VA home loan. Now, on a VA home loan, not everyone is eligible for it. That particular person has to be either a veteran, a service member, or a survivor. So if a person is a veteran, you would have to determine whether they're eligible for it by looking either at their DD-214, which is their discharge paper, or by going through the process of getting their certificate of eligibility. Getting the certificate of eligibility is going to determine whether that veteran, service member, or survivor is eligible to get a VA home loan. Not every certificate of eligibility will show that. There may be a time where we have to restore eligibility if the person had just purchased a home, actually just sold a home and didn't restore the eligibility, or it was a use of that certificate of eligibility. Maybe they have an active home with a VA home loan, or they had a short sale previously then what we need to do is go to that next step of eligibility, whereby we would have to go and calculate partial worksheet to determine whether they do qualify. We do all this, and believe it or not, we're able to get home loans, veterans closed on either having a short sale or having a partial eligibility. But it's something that you want to be sure that a person that you're dealing with is knowledgeable about all the intricacies of VA home loans, and that's something that I can attest that I am. So with a VA home loan, the person who is eligible to purchase a home loan, purchase with using VA, doesn't have to come with a down payment. Now, if this is a first use, this particular person is going to pay what's called a funding fee. Now, if it's the first use, it's going to be 2.3% of the base loan amount or the purchase price, because usually this is equal. They're going to be able to have that added to the base loan amount. So if it's a $300,000 home, you're going to take 2.3% of that $300,000. That particular funding fee is going to be added to the base loan to get a total loan amount. So if you're a subsequent user, meaning that this is not the first time, but you've used it before and you have no disability, then it's going to be 3.3% of the base loan amount or the purchase price to equal that, to calculate that funding fee. Now, if you have any type of disability, then you're not going to pay this funding fee. This is the way of VA giving back to that veteran who has been disabled as a result of either being in theater or some reason other than that. So if you're VA medically disabled, you will not be charged a funding fee. What's good in some states, if you're 100% VA disabled, you don't have to pay any property tax. For example, in the state of Texas, and I know that it's in Florida, you do not have, and if you're 100% VA disabled, you don't have to pay any property tax. That's a great way of buying a very large priced home and not having to pay that fee. We do have to confirm how long you've been in the military. So sometimes it's less than 90 days, or for whatever reason, a person didn't get out honorably, and we don't have the DD-214 to confirm that, but it comes back needing a manual upload to the VA portal to determine their eligibility. Just know that we're going to need that information. So again, we're going to check into that to make sure of that person's eligibility before we issue a pre-approval for a VA home loan. But there's so many great benefits for a VA home loan. I will tell you, I love working with my veterans, especially in getting them to closing with relatively nothing out of their pocket other than their earnest money deposit. It's just a wonderful feeling when you can help them to reach the closing table, and we've given so much to it, because it's just a great exhilarating feeling when you've done the job to help them get into their home of their dreams. If you come with me for a VA home loan, I will tell you, you will not pay any lender fees for your VA home loan. So some lenders will charge you 1 point origination. Some lenders will charge you the processing fee and the lender fee that will be actually required by the seller to pay. But when you come with me, I will not charge you any lender fees. USDA stands for United States Department of Agriculture. This particular loan was designed for low to moderate income families who didn't have any type of money for their down payment. Usually and typically these homes were in rural properties, rural areas, for example, outside the county limit or in agricultural areas. As years progressed, there have been USDA home loans that have been given for higher priced homes. So we have there is what's called an income eligibility as well as a property eligibility. Just because you qualify based on debt to income ratios, there is a requirement that must be met either by property as to where it's located, as well as income-wise, income eligibility. Also, there is a requirement for certain counties in certain areas as to how much a person can earn in order to qualify. So not everyone can get a USDA home loan. It's a very specific product for a very specific person. So with USDA home loans, if you're able and you qualify by property and you qualify by income, you do not have to you do not have to put any money down on this type of loan. It's 0%. So that's a great benefit. However, you do have to qualify with your ratios and all, and it's very, very specific. So if I were a realtor, I would make sure that you check to see if that particular listing does qualify for a USDA home loan, because that will increase the eligibility of some of your buyers to buy that home. Again, it's very specific. When you can get a client to qualify for this type of loan, it's the best. It's almost equal to VA home loans. But what you're doing is you're providing a way for the buyer to come in with a little bit of money, less money than the 3.5% down or the 5% down for conventional. So it's a really great product to look at and to see if this is something that your buyers possibly could qualify for. By familiarizing yourself with these government loans, you can help to find the best options for your clients. Remember to stay up to date with the latest program and guidelines to ensure that your clients are getting the best advice possible. Thanks for watching, and we hope that this has been helpful to you. If you have any questions, put them down below. And if you'd like the information, go ahead and like, share, and subscribe to my channel. Until next time, take care and stay financially savvy.